The US-Iran ceasefire appears to be over.
I think it's over. I don't want to deal with them anymore. They're scum.
Trump is ordering attacks on Iran while Iran is striking oil tankers. The price of oil briefly spiked above $90, and America's strategic petroleum reserves have fallen to their lowest level since 1983. Investors worry that massive inflation could be coming. And this is at a time when US stocks are already unstable due to fears of an AI bubble. As a former pension fund CEO and investment trainer, I'm getting a lot of worried questions from people whose life savings are invested in the market. So what should European investors do in this situation? Well, first, we've got to solve the puzzle of the markets in 2026. It's certainly been a stressful ride since the war broke out in February. Maybe you've been investing for retirement for decades, and now it feels like it's all threatened because of reckless decisions by the US president. But when you actually open your investment account, you see green, not red. Global markets did fall shortly after the war broke out, but then they went on to recover. And now the MSCI World Global Stock Index is up around 9% for the year. So what's going on here? Well, the AI revolution explains part of it. For the first half of 2026, we saw report after report of incredibly strong revenue growth for semiconductor and chip companies like Nvidia, Micron, and others. This pushed US tech stock prices higher and higher, and this masked weakness in other parts of the market. Now, recently, those tech stocks have begun to wobble, but the S&P 500 information technology sector is still up 15% for the year versus just 8.5% for the S&P 500 as a whole. But that's not the whole story. European and Canadian stocks are also up more than 10% for the year, and these are not markets dominated by big tech or AI companies. So why hasn't the Iran crisis caused the markets to crash? When it comes to the impact of a big oil price shock, most commentators look back to the 1970s when the outbreak of the Yom Kippur War sent oil prices to the sky. Almost everything in the modern economy depends on oil. You need it to fuel your car, to make plastics, and to transport food and clothes and other goods to the store. So when oil prices spiked, this provoked a decade of high inflation and poor stock returns around the world. The 1970s have been famously called a lost decade for stock investors. And here's something most people miss. The Iran crisis has today actually taken more oil off the market than 1973 did. Roughly 11.5% of world demand versus about 7% back then. So if you buy into the logic of the 70s, we should be heading for double-digit inflation and big trouble for stocks. Surprisingly, even though we're many months into the conflict, the inflation shock hasn't really happened yet. Euro area inflation actually went down to 2.8% per year in the June data. US inflation went down to 3.5% after peaking at 4.2% in May. Now, you could make the argument that this is because of, first, hopes for a quick end to the war, which seems less likely now that the ceasefire is failing, and second, because governments around the world have been using up their oil reserves, which can't last forever. The 32 members of the International Energy Agency have released a record 400 million barrels, leaving remaining reserves at historical lows. In other oil shocks, you could hope for OPEC, the Organization of Petroleum Exporting Countries, to increase production from its spare capacity, which is more than 4 million barrels a day. But almost all of that spare capacity sits behind the Strait of Hormuz, which basically makes it useless in this situation. So there are many convincing arguments for why a massive inflation shock is likely and a stock crash is very possible. But here's the thing about the markets. If all investors believed that a crash is inevitable, that crash would have already happened. The fact that it hasn't tells us that many investors see a different side to the story. For one thing, not every historical spike in oil prices led to a big crash. For example, in 1990, Iraq invaded Kuwait. As a result, oil prices more than doubled. That's a bigger price spike than what we've seen today. But what happened next? Well, the US stock market dipped for a few months, but then it recovered. Stocks went on to produce massive results throughout the 1990s. Investors who sold stocks anticipating a massive crash missed out on excellent returns. For another thing, the world's addiction to oil is much smaller today than it was in the 70s or even in the 90s. As this chart shows, it takes less than half as much oil to produce $1 of economic output today compared to 50 years ago. As a third balancing factor, the world is rapidly transitioning to renewable energy sources, and the global energy markets are a lot more flexible today, a lot more able to make up shortfalls in one energy source by substituting others. Finally, if we look at US stocks in particular, back in 1973, an oil shock was purely a problem for America. But today, the US is actually a net exporter of oil, and that means certain parts of the American economy actually benefit when oil prices go up. All these factors help explain why the markets have looked at the Iran crisis so far and basically shrugged. If anything, the impact of the conflict has been felt more by conservative investors, such as those approaching retirement or in retirement, who hold a lot of bonds in their portfolio. Because when the market fears inflation might increase, interest rates shoot up. And when interest rates go up, bond prices fall. This is why the iShares Core Euro Corporate Bond ETF is up just 0.5% for the year, while inflation has been close to 3% per year here in Europe. Most of the coupon income from holding these high-quality bonds has been erased by a fall in prices, which is normal behavior for bonds, but it can be an unpleasant shock if you're a retirement investor who imagined bond prices always stay stable or go up. So what should you do about it? How do you make good decisions about investing your life savings today in the summer of 2026? Before I explain that, let me mention that I expect the next few years to be a stressful time in the market. And if you're navigating this as an investor on your own, it can be difficult to understand what is important and what can be ignored. That's exactly why I write a newsletter for European investors, where I cover market news, but I also teach investing principles, which are helpful whether you are 50 plus and investing for retirement, or 30 plus and investing for maybe early retirement or financial freedom. So to join more than 100,000 readers, just follow the link below this video to sign up. Okay, so to make good investment decisions right now, you have to understand 3 principles, which are all true at the same time. To understand the first principle, remember this. Yes, the world has a lot of very real problems. The Iran conflict, Russian aggression, Trump's tariffs, climate change, the AI revolution. I mean, all of these problems are real and they can have a significant negative impact. But at the same time, the world has always had problems. We've had global wars. We've had massive economic conflicts. We've had recessions and depressions. And the long-term market results that we've seen, well, they've been incredibly strong despite all these problems. When you hold a classic 60-40 stock bond portfolio, it's not because you expect the market to go up in a straight line. You expect that there will be times like this. So the first principle is scary news cycles are a normal part of investing. Here's the second principle. To understand it, wait for a moment when you're feeling happy and optimistic. Then open your favorite news website, start a timer, and begin to scroll. See how long you can scroll without starting to feel scared or depressed. Chances are it's not going to be that long. And this is not because the world is in a worse situation than ever before. I mean, if you read the excellent book Factfulness by Hans Rosling, you know it's kind of actually the opposite. The problem is that today, we live in a news environment that is driven to optimize clicks. And research shows that people click more on negative headlines. Even if there are 99 good things happening around the world and there's one bad thing, everybody's going to be writing about that bad thing. As a result, we consistently overestimate how bad things are and underestimate how good things are. Now, this does not mean that the market will always go up. It does not mean we're not going to have problems or crashes. But here's the second principle. Don't trust your ability to evaluate how good or bad a market situation is. That is actually very, very difficult to do. And now we get to the third principle, which is where even professional investors tend to stumble. Even if you could compensate for your emotions, even if you could form a perfectly objective picture of the good and bad things happening in the world, because of this third principle, investing would remain difficult. So here's the principle. In the market, bad news and good news often look exactly the same. And many events are actually both depending on the time horizon. Now, I don't mean to be glib. Any war is a tragedy and it's objectively bad from a moral perspective. But just because something is bad ethically or morally doesn't mean it's going to cause markets to crash or to underperform long term. Now, in the short term, you can even have paradoxical situations like a war breaking out causing a pop in stock prices, or a good economic report causing markets to fall because the news was already expected. But predicting market movements gets even harder over the long term. Yes, if you shut down the Strait of Hormuz, that is going to limit the flow of oil and natural gas. It is going to push up prices. But we don't know the long-term impact on the global economy and on global energy supplies. What if this crisis accelerates the green energy transition around the world? What if it leads to new technological innovation spurred by higher energy prices? In the first few years, you might have a negative economic impact, but looking out 5, 10, 15 years, it might be a big positive. And that's actually the time frame of a typical retirement investor. You should not be thinking in terms of months, but in terms of years or even decades. The same kind of logic applies to the AI bubble, by the way. I mean, in the short term, of course, it is very possible we could have a big stock crash. But over the long term, I mean, the same way that the dot-com bubble laid the foundation of the internet economy, this AI bubble may be laying the foundation for the AI economy that we're going to benefit from as investors for decades to come. So if you're looking at the news in the summer of 2026 and wondering what you need to do, I would remember these 3 principles. Scary news are a normal part of investing. It is hard to judge news objectively, and it's very difficult to distinguish good news and bad news, especially over the long term. Trying to guess what will happen next in the market is basically a fool's errand. So here's the only sensible thing for an investor to do, and it took me many years of investing experience to really learn this. Don't guess. Don't make predictions about where the market will go. Choose a strategy for growing and protecting your wealth that is resilient. This means it needs to anticipate that problems will happen. We don't know when, we don't know what exactly, but they will happen, and the strategy needs to be built to survive these problems. So here's how you do that. First, you always make sure that you've got enough cash on hand so that you can live for a few months or longer if something happens to your income. I'm talking about money which sits uninvested in a bank account for a rainy day. So this is your safety cushion. Second, check that your portfolio is appropriate for your age and for how much risk you're happy to take. 100% in stocks might be okay if you're age 30 and you have nerves of steel. But if you're really stressed out by the markets, or if you're 59 and 6 years from retirement, you will likely want a much more balanced approach so that your portfolio doesn't swing up and down quite so much every time the US president makes a tweet. And third, diversify. If your entire portfolio is in the NASDAQ 100, the big index of US tech stocks, well, that's fantastic when those stocks go up. But if the AI bubble bursts, you could get really hurt. If your entire portfolio is in US stocks, that is wonderful when the US does well, but it's an issue if the market crashes or if Trump decides to put higher taxes on European investors like he tried to do in 2025. So for those of you who want to protect your life savings better, it's a sensible idea to split your investments among different companies, different industries, different countries, and currencies. And as long as you do this, you should be able to open the news, see something crazy happening, and just say to yourself, here we go again, while knowing that over the long term, your savings will almost certainly do great. Now, all of this assumes that you're invested in a smart, diversified portfolio of stocks and bonds. But how do you build such a portfolio, especially if you're new to investing? Well, I explain exactly that in this video, so I recommend you watch it next.